Alright, in this video, I'm going to be talking about gaps, types of gaps, and how you can trade and benefit from them. Um, so there are different kind of gaps. So the most common gaps are area or common gaps. The second and important type is breakaway gaps. Third one would be runaway or measuring gaps, and the fourth and final one would be exhaustion gaps. So let's take on all these types one by one. Um, so gaps appear at important areas of support or resistance. Around areas of resistance, when a stock wants to move up and there's a fixed supply of shares at some fixed price. For example, here, and I'm looking at AMD. So you see, from 18th of Feb 2020 until um, 22nd July of 2020. So AMD was kind of facing a resistance here um, around $60 level. So there are different kind of gaps covered here. So number one, so this is a downside gap. So, and then again another downside gap, and then the prices starts to reverse from there. So stock gaps up on other side. So this is something which is called island reversal. So you see how the stock gaps up and there were no transactions within this price range, and then it trades there for a few days, and then it gaps up, and this price area is left completely untouched. So that would be your island reversal. um, but there's still no recognizable chart pattern or volume characteristics of which you can trade. So again, after a few days, stock gaps up, not a ton of volume behind it. So from here you can see, like, this is more like a cup shape pattern forming. um, so yeah, later on this appeared as a cup and handle pattern, you see. So this was a cup of several weeks, and then here, so this is the handle area. The volume generally remains light in the handle area, but I'll just focus on the gaps and their properties. So so we have already talked about island reversal and area gaps. So, like, this is a chart pattern forming, and any gaps within it, they have almost no significance. So you need not to pay much attention to them, because the price is still range bound and it's just going up and down. So but in here, so this was a decisive move. So a cup and handle price breaks out of it, and you see how it jumps above that range and is attended by a large volume. So this would be your breakaway gap. uh, most of the successful investors, speculators, and market wizards, um, they their experience says that the breakaway gaps are solid bets. So you can trade off the breakaway gaps. So when the prices break out of a certain pattern, or some price congestion, I can say, and they're attended by large volume, so you can consider that as a breakaway gap. So the second gap from here would be your runaway gap or the measuring gap. So the measuring means is that when these gaps appear, so they normally appear at half of the move, and then the you can assume that the half of the move is already completed, and then the stock has like a halfway more to go. So this would be almost 12% move. So when this gap appeared, so you can expect the stock to go 12%. So you see it goes up 12%, and after that there was this long sideways movement. So that's your runaway gap. And third and the final type of gaps is exhaustion gaps. So when um, when a stock has been rising steadily, um, and then so I'm going to switch to another stock. I have Nvidia here. It gives a very nice examples of so you see, once again same, the breakaway gap, not a ton of volume, still significantly higher volume, and then it holds that gap and then keeps moving. So here comes the measuring gap. You see, once again, from here it's probably again 12%, and when this gap appeared, so this is a halfway through the move, right? So you already know that, so 12%. So you want to sell somewhere around here, so that completes the move. So breakaway gap, runaway or measuring gap, and that's your exhaustion gap. So how it's different from runaway gap? So you see how this price congestion was there and the price was breaking out of that area, right? And then the move got accelerated. Even heavier volume started to come in. The move became obvious to everyone, and then it pushed through. Um, another it actually got a little bit past the 12%, but then this final gap, you see how far the price has moved from that price congestion. It has already come up 33% almost, and then this final gap appears, and the opposite thing is happening. So there's a red volume. So um, instead of the higher volume to the upside, there's a volume to the downside, and then after a few days it gives up that um, gap support. So the gaps are usually areas of support as well. So you see the prices generally do not come back through them, and if a stock gaps up, it's not attended by a higher volume, and within 3 days to 3 weeks your gap is filled, then you want to wait unless a heavier volume comes in and stock moves again through that area, and then it starts to hold there. So closing of gaps is a kind of sign of a weakness. So if it doesn't hold, then you should be skeptical of that move. Occasionally, in some cases, so a stock will gap up, it will hold for several days, move sideways, then may drift lower and undercut that gap support by 3 to 5%, and then it kind of muscles up and then again starts moving up. So that can still be tradable. Um, and that's all about gaps. So we have four kind of gaps. Once again, we have area gaps. You see how this gap here, so this is just within the pattern, it doesn't mean anything, it has no significance. Then you have breakaway gaps when price breaks away from the pattern. Then you have runaway gaps, and then finally you have exhaustion gaps.